In our personal finance feature tonight, looking at how to generate an income from your investments. And our guest is Warren Ingram, personal financial advisor and executive director at Galileo Capital. Good evening, Warren.
Good evening.
So how do you make money from your money then?
It's a good question, Ray, because if we look at what's happening in South Africa at the moment, the stock market is unfortunately drifting down again, and for the last nearly probably 3.5 years now, we haven't seen much return from the JSE. If we look at our cash, cash interest rates are coming down, so we're in a situation where our money isn't really generating a lot of interest and a lot of growth for us. Add to that now the property sector in South Africa not really doing particularly well, and suddenly investors who are looking for income are struggling. So it's a really good kind of topical question now, because retirees and people who are looking for money now are saying to themselves, I'm struggling to find a way to generate some income from my capital, and unfortunately they can't use capital growth, which is often the combination here. So, for example, if income is low, you can say, well, okay, if my capital is growing in value, I can get some kind of appreciation from that. But we're in a time where we're drifting, and that's a difficult situation. So I always think you've got to look at the different types of assets that we can buy and see where you can generate some income. So for most of us, I think property is kind of the top of mind always.
Right.
I guess it's obvious. Property generates rent, and rent's a form of income, so that's a good one. And at the moment, it's an interesting time, because I think if we look at the residential property market as a start, pretty much everywhere in South Africa except the broader Western Cape is really struggling. I mean, we're seeing the housing market is just not doing well, and tenants are not paying up like they would have done in the past. So that's a difficult one, I think, at the moment. And so, to me, I think another interesting sector within that property market will be the listed property space. So the property companies that own things like the big shopping malls and the big office buildings and the logistics warehouses, etc. That looks a little bit more interesting to me than the residential property market. I'm not saying that it's a booming place, but you can find property companies there that are giving you, rent of about 8 to 10% of the value of your capital that you put in there. Mm-hmm. And I think that to me is attractive, because at the moment, what is that rent might not shoot up at 10 or 12% a year like it did in the past when inflation was a lot higher, but if it's at least tracking inflation. So if your rent was 10,000 Rand a month and a year ago, that it's going to at least rise with the rate of inflation. So it's going to go from 10 to whatever it is, 11,000, or it's not 11,000, but let's say it's 10,600.
Right.
So I think that's a sector that one should definitely consider when you're looking for income from your investments. But I wouldn't put all my money in there. I think in a time like we're in now, where everything is so uncertain. I mean, everything that you've been speaking about is major uncertainty. I mean, all of this whole fight that you've been talking about now with it's creating uncertainty. If we look at North Korea, and we look at Trump, and we look at the world, we're not in a kind of a nice, smooth, stable place. So what that means then is if you're investing for income, you've got to spread your eggs across as many different baskets as you can possibly find. So property is one.
Yeah, but are there green shoots when you speak about property? And a lot of people, and I hear what you say, they're thinking, all this is going on, I need to get out of here. But there is, like I said in the intro, there is a bit of light at the end of the tunnel. It's not as bad as all that. We've got business leadership South Africa standing up. We've got other companies also standing up. Maybe just hold on a little bit.
I think it's a heck of a stand to take now.
Yeah.
I think if we're talking about, I'm always going to divide them up into the physical properties and the property companies that you can buy and sell at the drop of a hat. Physical properties, I think I would agree with you, Ray. Like, I think if you're in them now, it's going to cost you a lot of money to sell, because there's always massive transaction costs with physical property, and that transaction time period takes a heck of a long time to actually sell your property, get the money physically paid across to you. So in that situation, I think I would take your view that whatever's happening at the moment, that either, if we're optimistic, what we're saying is that the bad news is really all out there already. That this is as bad as it gets, and somewhere in the next months or weeks or months, we're going to see some kind of resolution to some of our uncertainty, and then those green shoots start.
Right. Can you use shares or EFTs or ETFs rather for income?
You can. I think so you just need to use it as part of a bigger portfolio of assets. In other words, you can't just buy, let's just say the top 40 index in an exchange traded fund and expect to get a really serious a monthly income from that. The reason is companies generally pay dividends twice a year. And so when you buy an exchange traded fund that invests in shares, you'll also get those dividends and you'll also get them twice a year. But what you need to know is it's probably only going to give you about 2 or 3% of the value of the capital that you put in there. So if you put in, you put in $100, you're going to get $2 or $3 out of that as income. But what's really good about shares is generally, and I know the last 3 years haven't proven that, but generally your income that you get from shares rises quite significantly. And so your growth on income from shares is there. And then when you get capital growth from shares as well, it becomes a very nice kind of a spice in a portfolio to combine with something like property as well. So you're getting growth from your shares, which is, hopefully faster than the inflation rate. And then you've got your property, which is giving you rent. And at least if that rent is tracking inflation,
right,
then you've got capital growth going faster than inflation and rent going at inflation. So to me, you're starting to get somewhere. Now you can see I'm laying out the ingredients here for a nice meal.
Yeah. All right, let's carry on then. Income from unit trusts. That's an interesting one.
Yeah. So a lot of people will look at unit trusts and they'll look at, online now or grab the paper on a Saturday or Sunday and look at this massive list of unit trusts and they'll go to ones called income funds. And they'll say, right, I need income. I've got capital. There's an income fund. Surely that just solves my problem. Well, not really. Again, I think it forms part of this dish that we're busy putting together. The reason is that income funds might give you 7 or 8% a year of interest, which looks very attractive when inflation might only be 6% or 6.5%, depending on your own cost of living.
Right.
But what you need to know is that's not really going to give you any capital growth. So it's going to stay relatively stagnant. And if you're paying tax on your income that you're getting, which you will because it's basically rent, then you might not be doing all that well. So to me, I think income funds can form a nice part of a portfolio, but certainly the mistake a lot of people are making right now is they're looking for certainty, they're looking for stability, they're over-investing their too much money into income unit trusts. So I think you need to, if you're going to look at unit trusts as an asset type,
right,
not a bad one. But what you need to rather do is say, okay, let me find a way to spread that. So in other words, let's look at things like in the unit trust world, things called moderate funds or conservative funds or stable funds will often be the kind of category that we're talking about here, because they'll have a nice allocation to interest generating investments, bonds or income type instruments. They'll have some property and then they'll have some shares. So as a combination, it starts to become something that's nicely spread and nicely diversified, and then gives you a good stream of income as well.
All right, then how much risk should you take? I mean, there's inflation, there are other risks as well.
Yeah, so I think the concern I have right now with people is that we are really going into risk averse mode because of all this uncertainty, and we're losing sight of inflation. So if we're earning a lot of interest, we're feeling like life's okay at the moment, we still need to get assets that are going to grow faster than the inflation rate. That means property companies and shares, and those are the risky assets. They do go up and they do go down, and often it feels uncomfortable. I think you cannot get away with having less than about 35 to 40% of your investment assets in those two asset classes.
Interesting.
For most of us, youngsters like you, Ray,
I
think you need to have about 2/3, so 66 to 75% in those kinds of growth assets.
That really is very interesting. Okay, so where do you put your money then? Or
where do I put mine?
Yes, come on. Let's put you on the spot right now. Where do you make your money grow? Or is it classified?
No, it's not classified. So I generally will invest where I talk and where we put our own clients' money. So for me, I like index investing. So I've got a big spread of index tracking investments. I've got some individual shares.
Right.
And if I had to look through that mix of assets that I was talking about, I think, outside of my own company, because obviously you've got to have your capital tied into your business. Outside of that, I think I've got about 75% in shares, with the balance split evenly between property companies, bonds, and a little bit of cash.
just not in construction. I see a Venn job they're battling at the moment.
Well, if you look at the construction sector and the retail sector, I think there's bad news there. And if you speak to some of the better analysts out there about the retail sector particularly, I think we've got used to an environment where we expect retail companies just to do incredibly well, just to dominate. And if there's a blip, that's all it is in their markets. But I think what we're going through now might well be a structural readjustment. In other words, they've now really truly been exposed to serious global competitors. And if we look at the clothing sector in South Africa, that's a case in point. Look at what happened to Studdefield. It's gone.
Yeah,
Edgars has taken a bath. So I think to me the retail sector is a problem, and to just jump in there expecting that this thing will bounce one day, you might be catching a falling piano rather than a nice bounce in the market. Construction, I think construction is interesting because a lot of construction companies will tell you that government is not spending on infrastructure, and often that's the kind of the key underpin to the whole construction sector. What's interesting is you talk to smaller construction related businesses. There's a company called Afrimat, and the CEO always says if you go and analyze the numbers, government is spending on infrastructure, but they're not doing it on these mega projects that we've all seen in the past. They're doing it at smaller levels, across many small projects, and making infrastructure spend there. So I think, construction sector, I think you've got to be clever about where you go, but I wouldn't just blindly follow the whole sector expecting it to recover.
Very interesting. Warren Ingram, personal financial advisor and executive director at Galileo Capital. Great to have you on the Money Show again, Warren.
Thank you, sir.